Good afternoon. I know people are still going to be continuing to come on in, but we want to get started in the interest of time. I'm Nancy Bagranoff, the Dean of the Robbins School of Business at the University of Richmond, and I would like to welcome you to what I believe is the 38th annual Stanley S. Watts Lecture, if my math is correct. This series began in 1974, and it was created to honor Stanley S. Watts, who was a 1943 graduate of the University of Richmond. And the purpose was to bring business and government leaders to our campus to talk about the financial services industry. And certainly hearing about the financial services industry today is particularly exciting. But I was thinking about, gosh, what was it like back in 1974? So I was trying to remember back to the economy in 1974 when this series first got its start. I do remember I worked for General Electric at that time in Syracuse, New York. And I remember in 1974 being very, very cold. You're always cold pretty much in Syracuse, New York, but we were particularly cold that year because we were trying not to use electricity. Those of you who are around may remember that. We had a real energy crisis, and the gasoline pumps were sometimes out, and sometimes we were wrapped around the corner trying to get our fuel. There was also actually a productivity decrease that year, and there was a lot of deregulation. But public enemy number one in 1974 was not Al Capone, and it wasn't the deficit. Does anybody remember what public enemy number one was in 1974? Gasoline. Pardon me? Gasoline. That was a big problem, but it wasn't what Gerald Ford declared public enemy number one. Whip inflation now. It was inflation. It wasn't the deficit. So that's just a little trip back in time to 1974. Of course, we've come a long way. We're going to hear a great speech today, I believe, from Chris Williams, and I'm so excited to have him here with us, the co-founder and managing director of Harris Williams & Company. And we thought it would be appropriate to have a student introduce him, one of our finance majors. Mike Collins, I've had the good pleasure of getting to know this year as I've gotten to know some of the Robbins School students and student leaders. And Mike is the senior manager of our Student Managed Investment Fund. He's also the vice president of the Robbins School of Business Student Government Association in charge of student affairs. He is a business major, and his concentrations are in finance and economics. And I learned at lunch today that he really loves statistics classes. Mike is going to be graduating this year, and he's going to go work for Credit Suisse in New York, so he's pretty excited about all of that. And now he will come up and introduce our speaker. Mike?
Good evening. I have the great privilege of introducing to you the man of the hour, Mr. Christopher Williams. Mr. Williams co-founded Harris Williams & Company in 1991 as a national investment banking firm focusing on mergers and acquisitions. Since the firm's founding in 1991, Mr. Williams has led Harris Williams to become one of the largest and most influential mergers and acquisitions boutiques in the country. With nearly 20 years of transactional experience, Mr. Williams has completed over 200 assignments involving either mergers and acquisitions or capital raising activities. Prior to co-founding Harris Williams, Mr. Williams was with Bowles, Hollowell, Connor & Company. Mr. Williams earned an MBA from Harvard Business School and a BS in Business Administration, magna cum laude, from Washington and Lee University. Mr. Williams lives in Richmond with his wife and 3 children. In addition, 2 of our graduating seniors, Matt McDermott and Jeff Fritsch, will be joining the firm in June, so we are very happy to have Chris here on campus. So without further ado, please welcome Mr. Christopher Williams.
Delighted to be here today, and Nancy and Mike, thank you for that. And I think it may be the first time I've been called the man of the hour, so I want my wife and 2 of my 3 kids to take that moment in, that I'm the man of the hour. But it's just great to be here today, and it's nice to be so close to home. Actually, I have a chance to talk in front of a number of groups like this one, but it's always in New York or Boston or Chicago. And you know if it's on my running route, it's got to be really close to my house. So this is on my running route. My wife and I come running down here all the time. So it's just a pleasure to be here today. And look, I've got a fair amount to kind of go through and talk about the markets, what led up to what was obviously an awful crash back in 08, 09, and kind of what we've seen since then. And I really want to make this an interactive discussion. So if you've got questions as I'm going through this and a topic you want to dive into a little bit more, raise your hand. There's certainly a Q&A section at the end, but happy to field questions as we're going through this. So please just raise your hand and we'll get you a mic and we'll go from there. First, I'll give you the obligatory 5-minute advertisement on Harris Williams, just so you know who we are, what we're all about, and probably the perspective I'm bringing to kind of the conversation today. As Mike said, we've got about 200 people. We've got 6 offices here in the States. We've got an office over in London, and probably one of the top 2 or 3 boutique M&A firms in the country. So what that means is that we're constantly advising buyers and sellers of businesses, mostly sellers of businesses, really focusing on transactions below $1 billion. So we'll talk about that in a minute, kind of what that means. But it's been very active. We started the business 21 years ago, and it's been a ton of fun to really grow from scratch. And we've got great people. Delighted that we had a couple of folks from graduating from here this year, and it was actually a very, very good class this year. If you look at some of the industries that we focus on, it's pretty broad. 7 or 8 years ago, we really had a generalist focus. No one focused on any one industry. But over the last 7 or 8 years, actually everybody has gone into an industry group. So groups like healthcare, technology, business services, aerospace and defense, just to name a few. We've got a very active consumer and food and beverage group. So, our business has become very broad, yet at the same time, I think specialization has become critical for us. In our world, which is super competitive, if you're not specialized and if you don't know your industry sector like at the back of your hand, you're not going to be nearly as successful. And that's why we've really gone that route the last 6 or 7 years. If you look at kind of the size of our deals, and I think this is interesting. I looked at the journal today, and everybody reads about the big transaction. That's what gets all the headlines, the north of $1 billion. In fact, in the journal, there were 3 today. Chesapeake Energy, I don't know if any of you read it, but Chesapeake Energy announced a $5 billion transaction. Danaher announced an acquisition of over $6 billion. And there was a oilfield services transaction that was about $7 billion. So that's what captures the headline, right? That's what you read about every day. That's what we all talk about. But it's really the middle market is where the action is. I mean, 95% of all the transactions in this country are below $1 billion. And that's what we work on. Average deal size is $200 million. And it's stuff that touches you every day. You read about the U-Crop sale last year. That was one that we had a chance to work on. We worked on an HVAC distributorship here in town that was roughly the same size. We worked on a transaction that makes institutional flooring like the one that you're walking on today. That's roughly a $400 million transaction. We worked on one that did little clips that high-def TVs are hung on in your house. Again, about a $500 million transaction. So things that you would never think of, things that don't show up in the paper, that's really where all the action is. In fact, one of my first great clients is in the audience today, Bill Hamill, who ran a really terrific paper business here in town. And we had the good fortune of helping Bill and his partner several years ago. And again, it probably never hit the Wall Street Journal, but I would venture to say it was a pretty critical deal in Bill's family life and was a great transaction for our firm. That's the kind of situation that we work on day in and day out. Last year, we'll talk about this in a little bit more depth. Last year was a terrific year for us, almost a record year, actually. We closed 65 transactions, bunch of different deals across different sectors, ranging in value from $50 million up to about $1 billion. And it really was just remarkable, the rebound from 2009, which was awful. I mean, we'll talk about 2009, but 2009 was probably something like I've never seen before, and I've been doing this for almost 25 years, but it was just that bad of a year. But we came out of it strong, and we feel like we're in very good shape. Okay, so let's talk about kind of the markets and what we learned and what we can take away from it. And this was, I don't know if you can see this, but it has a little car going around. It says boom, bust, bailout. And it says, how's that go? Those who don't learn from history, huh? So, I mean, we've all learned about the boom and bust in our various industries. And certainly we have it in the M&A world as well. There's a lot of data on this page, but I can tell you what it says. It says that, you're going to hit down markets, no doubt about it. But I think those who end up making a lot of money are those who have the confidence that our economy is going to be very resilient. And this tracks stock prices, unemployment, et cetera, 5 years out from the moment of a downturn. And I think that we're seeing that today, that the economy has come back and it's going to continue to come back. And we'll talk about, where people make money in a downturn. But certainly we've seen a very, very good pop-up in our market following the 2009 disaster that we had on our hands. So this is kind of a busy chart, but I think it's a very important one. It helps us when we think about our business. So this tracks M&A deal volume. Now this is transactions really, mostly in the middle market. And what we did is we put in yellow kind of the down markets. And this goes back to 1981. I got in this business in 1987, so I've been doing this 25 years. But this chart goes back, 30 years. And what it tells you is that the downturns in our market are actually fairly short. Most of them have been somewhere between 12 and 24 months in duration. And that has a big impact on the way you think about managing your business and the way you think about the industry. So, for example, when we hit 2009, like I said, it was an awful, awful market. People were in complete capital preservation mode. Private equity groups were not putting money out. Banks were not lending. I'll give you some of those statistics in a minute. Strategic buyers were like deer in the headlights. No one wanted to really take risk and put money out there. Even though, statistics will tell you, buyers who really make acquisitions in the downturns, those are the ones that do the best, but it's just so hard to bring yourself to do that. But what this chart tells you is that the downturns tend to be very short in duration. So when we think about running our business, when we hit a downturn, which we did in 2009, we could have pushed the panic button, we could have laid off people, we could have shut offices, we could have done all that, but we knew the market was going to come back. And so our attitude has always been, if we keep the ship intact, while a lot of the guys on Wall Street, they tend to expand and contract very quickly. Mike, I'm sure CSFB is not that way, but a lot of firms expand and contract very quickly, but they lose share when they come out of the downturn if they do that. Whereas if you keep your people, you keep them intact, you keep them motivated, then you can pick up share out of the downturn. And so even though we didn't have a crystal ball, we didn't know it was going to be short in duration, we thought that was likely to be the case. And indeed that was. So 2000 is funny. We sat around as a partnership in November of 2009 and guessed what our revenue was going to be for 2010. And we were just coming out of the depths of it in the fall of 2009. But we had double our revenue for 2010 versus 2009, and we missed it by 80%. I mean, we woefully missed it. We ended up doing way, way better than we thought. So that just tells you that, even though we've been doing this for a long time, we don't have a crystal ball how quickly things snap back, but they do tend to snap back very, very quickly. What this is a monthly deal chart, and it just tells you again that the downturn really was kind of a 12 or 18 month downturn, and it was really in kind of March, April of 2010 that we really saw it to kind of start coming out of the depths. And 2010 was a terrific year. We've got a very good backlog heading into next year. And I think it says a lot about the deal environment. When you think about it, you've got buyers, you've got strategic buyers, many of which have to make acquisitions. When you're a publicly traded company and you're traded at a fairly lofty multiple, yet the growth of your base business is fairly modest, you've got to make acquisitions. The deal today with Danaher is a perfect example of that. Danaher is a great company, but they're not growing at double-digit clip organically, yet they're trading at 9 times, 10 times EBITDA. So they've got to make an acquisition. They did a big one today. So we see that from strategic acquirers all the time. And financial buyers, private equity groups, which I'm sure all of you know about, it gets a lot of press, those funds have a defined life. Most of those funds tend to be a 6 or 7 year funds. If they don't put the money to work, they've got to get an extension or they got to give it back. And I can tell you, no private equity guy likes to give their money back. They want to put their money to work. So there's this just pent up demand for deals that cause the cycles to be fairly short. This is a chart that actually looks at multiples of deals. And it's really surprising. If you look at the top chart in 2009, the average multiple went from, and this is of EBITDA, which is earnings before interest, taxes, depreciation, and amortization. I used to think that no one knew what that term was until I actually saw it on The Sopranos one time. And I said, man, if it hits The Sopranos EBITDA, then everybody must know what it is. But anyway, the average multiple went from 9.5 to 7.5 from 2008 to 2009. That is a dramatic drop-off in the multiples that sellers were able to get for their businesses and buyers were willing to pay. I mean, it's almost an unprecedented drop-off of 2 turns of EBITDA. And it was depressed EBITDA as well, which is remarkable. Yet it's come back in 2010, and it's 8.6, and that 8.6 stacks up very well historically with multiples of EBITDA. So again, transaction volume has come back, and the multiples have come back very strong. It's been just an incredible snapback, and one that I'm not sure we knew was going to be quite as strong as it has been. We talked about private equity. And again, for all those who don't know really what private equity is, it gets a lot of press, but some people don't know what that term is. So it's pools of capital that are raised to invest primarily in private and public companies, and usually for control positions. And then they hold it for a number of years, and they sell those control positions, and then make a return for their partners who put money in those funds. And I've been doing this, like I said, for a long time. And back when I started in this business, private equity was just in its infancy. I mean, there were maybe 50 funds, 100 funds when I first started in this business. It's incredible how many funds there are. We'll talk about it in a few minutes. But the growth of private equity has been something that's really driven our industry to some degree. So you've got this massive, massive pools of capital that are out there looking for transactions. In fact, if you look at the amount of money that they've raised that's unspent, and if you lever that 3 or 4 to 1, these private equity funds have roughly 2.5 to 3 trillion of capital to spend. I mean, that is a remarkable, remarkable figure. So back in the heyday of 06, 07, you had companies like HCA being bought for over $30 billion. TXU down in Texas, a big utility, being bought for over $25 billion. I mean, you had massive transactions being done by big equity groups. And again, today, 3 transactions in the journal over $5 billion, which is remarkable. So a lot of this has been fueled by kind of the private equity world. This is really the number of funds out there, and you can see this chart. So there's over 4,000 funds today. And these are funds with at least $50 million in capital. So it's been an industry that has actually generated decent returns. And as everybody needs to, I'm sure you see the paper every day, people are looking for returns, whether it's the U of R endowment, whether it's the Virginia retirement system. Everybody's looking for yield and looking for return. And private equity has certainly been the juice behind, pretty good returns in the past. Thus, the asset class has kind of continued to gain steam. So how bad was it? So you probably can't see this. It says, I'm in a hole and I've stopped digging. Unfortunately, I'm down here with the evil robot I invented. And the evil robot says structured investment vehicle. So what happened back in certainly the 2005, 6, 7 era is just we became over-levered in so many ways. The banks were out there doing a lot of frothy lending. There was collateralized debt, not only mortgage debt, but also debt that was put on businesses. And it just kind of got out of hand. We did a number of transactions, frankly, back in 2006, 2007, where the buyers were using over 6 times EBITDA for leverage. And when you're at that level, everything has to go right. And if it doesn't go right, you're in a world of hurt. And so no surprise that when the market went down, people were really in a fair amount of trouble if they were in an over-leveraged situation. And we'll talk about that. So you look at Lehman. I drew a line here for Lehman. So a couple things. One was the default rate. Default rate is a measurement they use of how many highly leveraged transactions actually go into default on their covenants for their debt. So it's kind of a technical term to say when a company's really in trouble and it defaults on its debt, then you got to bring all the banks to the table and renegotiate the debt. And you can see back in the beginning of 2008, the default rate was almost 0%, which is crazy. I mean, almost by definition, that can't be sustainable. And it popped up to about 10%. There were a bunch of articles that said that the default rate was going to go to 20%, which would have been really unprecedented. It actually topped out at 9 or 10%, which was fairly manageable. I mean, actually, banks renegotiated covenants, and it was very manageable. And if you go to this chart, always blows my mind. And so, particularly the one on the right. So what this is, this tracks the pricing of a basket of debt for highly leveraged loans. And so what it tells you is that these highly leveraged loans, and this is senior debt, was trading at around par, so 100 cents on the dollar roughly, back in 2007. And then it fell during the depths to roughly 60 cents on the dollar. Now these are names that you would know, like a First Data, et cetera. And so it meant that the pricing of debt, existing debt out there, you could buy it for 65 cents on the dollar. And so banks weren't making new loans. And loans that they had been put out there were trading at an incredible discount. If you could look back, this was the opportunity that we all missed. I mean, if you could go back and buy debt, good debt, at 65 cents on the dollar, and this is what the smart money was doing. I mean, one of the reasons that private equity groups weren't really completing many transactions in 2009, they were going and buying back the debt of their portfolio companies because they said, look, man, I can buy senior debt for 65 cents on the dollar. Why would I not do that? And so we had to get that overhang out of the market and get it cleared out before transactions started moving again. And so it just took a little while, but finally kind of in the spring of 2010, that really kind of came back. You can see it started going up. Now it's like 95 cents on the dollar. Now new transactions, are really taking hold and people are being very active. But we had to get that debt cleared out of the market and had to have new buyers, and the distressed buyers had to sell that debt and it had to be absorbed. So how did buyers react? What did they do? So for strategic buyers, 2009 was a hunker down. I can't tell you the number of transactions we had, and you had one or two strategic buyers that you felt this was a no-brainer for, and you just could not get them to drink water. You led them to it, and they just wouldn't bite. And part of it was they were scared to death. I mean, they were absolutely scared to death. I remember we closed one transaction in September of 2008, so right when Lehman was happening. Great strategic deal. This was about a $200 million transaction. It was kind of oil field services. This company made the umbilical cords that run down to deep water drilling, off of deep water drilling rigs. And the buyer was a big public buyer. They had plenty of debt availability. They actually drew down the debt 3 weeks before closing and incurred the interest costs because they were scared the banks would not honor their revolver and their debt package, which is remarkable. I mean, it's basically saying I don't have enough confidence in B of A and some of these big banks that they'll actually honor my credit agreement and lend me the money that we've already agreed to borrow. So they actually drew it down early and they paid the interest to draw it down early. I mean, that's the mentality that was out there in late 2008, early 2009. It was crazy how people just were like deer in the headlights. But, ultimately we got through it. So we had strategics that were deer in the headlights. You had financial buyers that just couldn't get capital. There was no debt to borrow. So they shifted gears. I mean, financial buyers, if nothing else, they're incredibly resourceful, incredibly creative, incredibly resilient. And so if they couldn't borrow new money, they just said, hey, I'll reposition myself and I'll take minority positions of all equity. I'll just put equity in a company. I don't need to borrow new money. I'll just put equity in a company. And that's what a lot of them did, very, very successfully, by the way. So we'll look back in history, and the money that was put to work in '09 will be some of the highest returning investments these private equity groups will have made, for sure. So surviving the downturn. So what kind of companies survived? It's so funny. When you're in the hot market and things are going great, you always talk about companies' business models and that they're resilient to a downturn, recession resistant. I mean, how many times have we said that about a company we're representing? Well, '09 tested the model, let me tell you. And so the companies that survived late '08 and '09 and '10 and actually performed well really did prove out their model. And I'll tell you, from what I've seen, American business in general, I think, reacted very quickly to this downturn. I was amazed. And again, we deal with a lot of middle market companies, so this is not the GEs of the world. People cut cost. They took out fat from their operations. And I think management teams in general did a very good job working their way through this downturn. But really, the companies that had business models that could hold revenue, even in a downturn, those are the ones that really were the most resilient. And they tend to be the ones that are most sought after today because they proved out their business model. And so I was thinking about a couple examples. One example, we sold a business this past year called Keenan. You may have seen their trucks on the road. This company basically hauls fuel from fuel depots off of the pipeline to a 7-Eleven or a gas station. That stuff doesn't get there by magic. It has to be delivered by, a truck. And so you can think of a very recession-resistant business, right? I mean, we're using our cars and we're using gas about at the same rate in a downturn as we are a healthy market. In fact, miles driven backed off by 1 or 2% of the downturn. So in theory, a great business model. And Keenan proved it. I mean, Keenan just grew right through '09, 2010. They made acquisitions of some smaller troubled businesses they were able to pick up. And because of that, they garnered a great multiple when we sold this business early in the year. We sold it to Goldman Sachs Merchant Banking Fund, which is about a $20 billion fund. This was a great transaction. But it's the kind of business model that really proved itself out in the downturn. So the rise of the boutique M&A advisor. Again, CSFB accepted, great firm. But it says, caution falling banks. Well, certainly we learned over the last couple of years that really no bank is immune or untouchable. I mean, I don't know if you recall, but there was a time in the fall of '08 where people really thought Goldman Sachs was going under. I don't know if y'all remember this. There was probably about a 4-week period where people were not sure if Goldman Sachs was going to survive. And now that's a pretty remarkable statement. And I mean, look what happened to Wachovia, forced to really sell to Wells at a nothing price, really. So I mean, it was just, the change in players on the street was incredible. It wasn't just Lehman, but just the way the dominoes fell for that 3 or 4 months was just incredible. And so what happened is you had the rise of what we call the boutique. And a boutique is an advisory firm that doesn't have a balance sheet. They're not necessarily trying to be all things to all people. They're really offering advice, whether it's buying, selling, IPOs, raising capital, but they're offering advice. And if you look at the market share of boutiques, market share of boutique firms has gone up from roughly 25% to almost 40% today. So think about that, from 25 to 40%. I mean, that's a huge pop-up in terms of their market share. And I think we're going to see this throughout. And certainly this is, one of the reasons that we've picked up share, and I think others like us will continue to pick up share. I love this one. This one's the glow. You can't see this, I'm sure it says, I'm so excited about our China deal. I just feel warm all over. And the assistant says, are you sure it isn't the Szechuan noodles you had for lunch? So it's talking about the global nature of our business. So it's interesting. A couple weeks ago, I had a chance to go over to Hong Kong and Mumbai. We've actually put partnerships in place with boutique advisory firms in China and also India, because so many of our clients think that, wow, the buyer for my business or the investor for my business is going to be over in China, or it's going to be somebody in India, or it's going to be somebody in Japan. I mean, this is becoming a very, very global market pretty quickly. And if you look at this chart, this talks about the number of cross-border deals. And the gold chart talks about outbound deals. So that's deals in the U.S. that were bought by a buyer overseas versus, a U.S. buyer who goes overseas to buy someone versus inbound, where a foreign buyer comes in and buys a company here in the States. But you can see that the downturn in 2009 was not nearly as significant as the overall market. So in other words, cross-border deals were much more resilient in the downturn than all other transactions. And this does not surprise me. I mean, I think our business is going to become more and more global. We have to have access to buyers overseas. And, you read the paper every day. One of the transactions today, the oilfield services deal, involved a UK company and a US-based company. And that's what we're seeing kind of day in and day out, even in the middle market. To date, we've actually had very good success finding international investors for the companies that we sell. Roughly 20% of our buyers have come from international strategic buyers. I will say, so far it's been heavy Europe. I mean, if you really looked at where our buyers have come from, I bet of that 20% that have been from overseas, I bet 3/4 of those have been from Europe. But I do think that's going to change. We sold 2 to Indian-based buyers last year and 1 to a China-based buyer, and I think that's the way this is going to evolve. So, maybe not in my career, but in Mike's career, I think he'll see these statistics are going to be very, very different. And this is kind of welcome to the middle. So we pride ourselves on trying, again, to offer global services. So what does the future look like? So a couple market observations. Number one is definitely a continued flight to quality. Now, I will say that we're starting to see some companies that I would say are not the A+ companies, but maybe the A- to B+ companies starting to come to market. Back in early 2010, you had to have a great business in order to attract a lot of attention. But the market's changing. It's becoming definitely more heated. So you're starting to see a little bit less quality company come to market and still attract attention. I mean, no doubt about it. Part of last year, our volume was driven to some degree by the tax changes. Everybody thought capital gains was going to go up. I mean, it was, you just said, capital gains, it's definitely going to change. It was on the Obama agenda. It seemed to be getting momentum. So you had all these sellers back in February, March, April say, oh man, I got to sell my business. If I'm going to do it, I got to hit the window 2010. Well, lo and behold, the tax changes didn't happen, but sale processes were already kind of well underway, and it was just too far to draw them back. So we definitely had some tax-driven transactions last year. I don't see that this year so far. I don't think people are doing it for tax reasons, but we have very good backlog. Just, again, businesses are starting to perform better, and so people are looking for a change in ownership in order to liquidate their holdings. We talked about purchasers being very active. And again, strategic buyers are really active right now, and this is across the globe. Again, I think the deals in the journal today are certainly an example of that, but we see mid-cap, we see large-cap companies being very active. We're actually selling a deal. It closes on Thursday, And this tells you how eclectic our business is. This company makes electronic monitoring for prisoners. So hopefully none of you have ever experienced this product. If you have, raise your hand. We'll love to get the story. But they make electronic monitoring equipment. If Lindsay Lohan was here, I'm sure she's a frequent user. But we're selling it to a company that's about a $2 billion market cap company called Geo. This has been publicly announced. And Geo is tapping the high yield market in order to finance this deal. So they're going to the public markets to raise debt, and they got a tremendous reception to raise enough debt to do this deal. This deal is a $415 million transaction. So again, just right down the middle of kind of the middle market, perfect deal. The buyer is able to access leverage in the public markets. Perfect deal, very accretive for them. So it works very well. And the last box at the bottom is the debt markets. And you kind of see this through the paper about, mortgages are obviously at pretty low rates. Let me tell you, banks want to lend capital right now. I mean, if you go talk to banks, they are anxious to put money to work. Now, that's not to say they've lowered their credit, quality, but they very much want to put capital to work. There's no doubt about it. The public high yield market, which we'll talk about in a minute, has definitely opened up. And so the credit markets have just loosened up big time. So back in the depths, kind of early 09, mid 09, maximum leverage tended to be 3 times EBITDA, maybe 3.25, 3.5 in that range. Today, we're pretty consistently seeing 5 times leverage, 5.25 times leverage. Now, I feel good at that leverage level. I think that's very sustainable. I think that's a healthy market. When it gets to 6 to 6.25, that's when I get nervous. But I think 5 times leverage is about equilibrium in my mind. And we've certainly seen it come roaring back. We've talked about buying power. This is what I referenced a little while ago. So if you look at this chart on the left, it's amazing, right? I mean, so private equity groups have $500 to $600 billion of equity, unspent equity. So if you lever that 3 or 4 or 5 to 1, think about the buying power locked up in private equity groups. I mean, it's $2.5 trillion of buying power. Remarkable. And then if you look at the cash balance, corporations are fairly healthy. I mean, the chart on the right is the cash balance of the S&P 500. So just in the S&P 500, there's $1.5 trillion of cash. So I mean, buyers right now, have a lot of cash to do transactions, and this is part of the reason we're so bullish, in the outcome or the outlook for 2011, 2012. If you look at financial buyer interest, we've talked a lot about this again. Very strong from a multiples paid. They're willing to over-equitize transactions in order to get them done. That's part of the reason prices have popped up, part of the reason that there's a lot of deal activity out there right now. And this is just talking about, again, private equity activity. Now, this chart is very interesting to me. So this is a company, Boston Consulting Group, that went back and looked in private equity portfolios and said, okay, when were the best transactions done? So in other words, what transactions ultimately generated the highest return for partners? And it's very interesting, and it's kind of what you would expect. The best deals that private equity groups have done have been in the down markets. So you buy companies not only with depressed earnings, so you're buying a trough level of earnings, but you're actually buying them at lower multiples. So when things come back, not only do earnings accelerate, but you get a multiple expansion. Thus, you have great returns. And so that's kind of what this chart says, but it's so hard to break a herd mentality. When you're a private equity group or any buyer, and you get a market like 2009, I'm telling you, people were scared to death. I mean, they were scared to death. And it's very hard to break that cycle and step up and use 60% equity or 70% equity to do a deal. But the groups that find a way to break that fear cycle and make acquisitions in the bad markets, those are the ones who ultimately make the best returns for their client. This is kind of economic conditions. Where are we? So, you've seen we've come back. GDP is starting to return. Actually, we're fairly bullish. I mean, when we look across our client base, we see our clients, with pretty good hiring right now. And, unemployment is now, 9.1, stuff like that. So it's definitely come down from the high of around 10. I don't think it's going to be a quick pop back to 5 or 6% unemployment, but it's going to come back. And look, it's going to take time. This was a nasty, nasty, nasty recession, but it is going to come back. And I think the American business is just very resilient. So it will take time, but it will snap back. And then you've got a couple manufacturing statistics here talking about, we've got some strength in manufacturing for sure. This is talking about the stock market. If we were all, soothsayers and would put money in the market at the right time, which is never the case. But if you look back into the depths, February of 2009 versus today, it's come back almost 90%. So again, I think faith in our economy and faith in our businesses in downturns is certainly rewarded, as hard as it is. We could all be our own little private equity group, right? So how many of you in February, March, or April of 2009 put more money in the stock market, right? That was a tough thing to do. I mean, I certainly didn't. I wasn't sitting there stroking money into the market. But in hindsight, that's what we should have done. So breaking that cycle in a downturn certainly leads to good returns. We look at the debt markets, the high yield market. This is publicly issued debt. So this is like the deal we're selling this week where the corporation needs to go tap the credit markets. You can either get it from banks privately, or you can actually issue high yield debt out there in the market, almost like an IPO, but you're doing it with debt. And as you can see, it has come roaring back. Roaring back. This is very good for our business, certainly good for the economy when there's that much available leverage out there. This is talking about prices and talking about leverage, and again, very strong statistics. All right, so I hate to end on a downer, but I got to talk about this. The one thing that just scares me to death is the debt situation in our country right now. This talks about a couple statistics of our leverage growth versus some other industrialized nations. And certainly there are nations that are worse. If you look at Japan, it's clearly a worse leverage situation than the United States. But we have got to find a way to have the courage, and the politicians have to find a way to have the courage to answer the bell on this problem. We can't keep putting our head in the sand, or my kids who are sitting in the back are gonna pay the price. Not so much me or Bill or some others in this audience, but the young people in the audience and our children are the ones who are going to bear this problem, and it's a real problem. If we leave the debt unchecked, think about what's going to happen. You're going to have China and other countries who aren't going to be so willing to buy our debt, and we're going to have interest rates pop up. I just don't know how interest rates are not going to pop up in the long term. I realize in the short term, safety is good, and that's the reason that we're able to have our debt be so low from an interest-bearing standpoint. But over time, I don't see how that doesn't pop up. Just unless we handle the debt situation. Commodities will become more expensive. If our dollar's worth less, it's going to take more dollars to buy certain commodity goods, which is not good for our manufacturing base. So, look, we have got to tackle this problem. I thought a healthy first step was the debt commission that was led by Alan Simpson and Erskine Bowles. Erskine was a guy I used to work for, a mentor of mine. I thought they did a very good job at least laying out some guidelines. But, if any of you are involved in politics, and to a degree we're all involved in politics, this is a problem we can't stick our head in the sand anymore, in my opinion, or it will hurt our competitiveness going forward. So we are bullish on kind of where we're headed. We think that our business is very strong. We see it every day. We've got good leads coming in, and we're looking forward to kind of a continued growth in our business. Hopefully we'll continue to hire great U of R students. We certainly have seen some good ones, and we want to keep doing that. Happy to answer any questions that you may have. So I'll throw it open to the floor. Anything and everything is inbound, so don't be scared to ask. Eric, you better ask something. Yes. Well, I think I think we're going to have to hit it from a bunch of different angles. We can't say. I mean, it's interesting when you look at the states. I mean, there's an article today. States are tackling their debt problems. At least they're trying to. I think in a much more aggressive way. You go over to the UK, and 6 months ago when they elected a new government over there, their government budget went down 14%. Can you imagine if we put out a budget that was down 14% from the prior year? I mean, it would be, I don't know what people would think, but nothing is out of bounds. I mean, look, this may not be popular, but I've been Republican all my life, but defense is not, you can't keep spending at the rate we're spending. I mean, we spend 10 times the amount of the Chinese on defense. And, we just can't afford that. I don't mean to get up here on the political stump. I mean, the point is nothing is out of bounds, and I think the politicians have to have the courage to tackle the tough problems. The entitlement programs we've got to tackle. And maybe that means you're raising the age on Social Security and other things, but we've got to tackle it. Not an easy solution, but I think the Debt Commission actually did a fairly good job laying out 6 or 7 different concrete steps that we could take. Yes?
With the debt and the amount of money that's come into the economy, what's your prognosis with regard to inflation and interest rates over the next few years?
Well, I think the next couple of years, interest rates are going to stay relatively low, if I had to prognosticate. And my forecast is probably as good as anybody in the room. But I think it's going to be fairly low. But I think long term, I think they're going to pop up. I feel that we're not going to have buyers for our government-issued debt like we do today. And at some point, that's going to turn against us. And I think we're going to have to raise rates in order to issue the bonds. So I don't know if that's 5 years down the road, 10 years down the road, but I feel like it's coming. I feel like it's coming. Hopefully never back to the 81, 82, 17% mortgages. A lot of you weren't born then, but that was a pretty bad time. Hopefully never to that level, but I think it's going to come up. That's my bet. Yes, Bill.
Chris, what advice would you give to students who have given some thought to entering the investment banking profession?
My advice would be find an area in investment banking that you love. I mean, it could be, M&A advisory like I do. It could be, Mike, what area are you going in next year? Sales and trading. It could be sales and trading. It could be derivatives. It could be, high yield groups within banks. Because, man, this is a tough job. I mean, at the reception, ask my wife how many nights I've been on the road for the last 25 years. I mean, it's a lot of nights, and you pay a lot of sacrifices. So you've got to enjoy what you're doing. I mean, you got to love what you're doing. And if you don't like it and you're just doing it to get a name on your resume, life is too short for that. You just do it if you love it, but find an area within the bank that you feel like your skills are really matched, and then pour your heart and soul into it. I mean, that would be my advice.
Chris, what about educational preparation for the investment banking business?
Well, it's interesting. We hire, how many undergrads, Kim, do we hire a year? Probably 40? We have an analyst program across our 6 offices. We probably hire 35 or 40 undergrads a year because we have a rotation just like New York. And we've kind of fallen into this trap where we tend to look at business and econ majors. And so I think if you want to go into investment banking and you're an undergraduate, you probably need to at least be very facile in accounting and some basic business courses. But I'm also always looking for somebody who's got something different. Like, I love the person who started their painting business in the summer, versus someone who worked at a brokerage firm that their father or mother got on the job. I love that something different that really showed me that they knew how to work hard. For graduate students, when you go to an MBA program, which is typically where we hire associates, and we hire how many associates a year? Probably 20. I'm guessing 20. It can be, someone could have a concentration in accounting, finance, entrepreneurship. It doesn't really matter. When someone has an MBA, we expect them to have a basic knowledge of accounting and finance, and they're going to be fine. And in that case, we're just looking for a great cultural fit with our firm. Because again, it's a hard job. Don't let anybody tell you anything different. It's a hard job. You're there for long hours, and you got to enjoy the people you're with. So we're looking for, young men and young women who are just a great cultural fit with our firm. And I think we've done that very well over the years. Other questions? Anything? Nothing's out of bounds. Yep. I do. If you look at public market returns over the last 10 or 12 years, they hadn't been so hot. Yeah, you could have gotten in March of '09 and made a lot of money. But if you just really look at public market returns over a 10 or 15-year period, they've been okay, not great. Private equity returns over that period, even though returns have come down as that market matures, still are a very good premium over the public market returns during that same time period. If you look at highest quartile private equity, and everybody thinks they're highest quartile private equity. I haven't met anybody who's the lowest quartile private equity. It just doesn't. It's like when compensation, when you look at analysts and associates, everybody's highest quartile. No one's ever lowest quartile. But anyway, if you look at highest quartile private equity returns versus public markets, tremendous premium, tremendous. So we just talked about the debt situation with states, pension funds. Think about it. Pension funds, there's a lot of state pension funds that are absolutely underwater, absolutely underwater. They've got to make 7 or 8, 9% returns a year in order to get themselves above water. Well, the only place they're going to get that kind of juiced returns is something like private equity. So, good. I think the need for the yield is there. And I think over time, it's proven itself as an asset class. And that's why you see more and more money that's poured into it. It's not going in there just to line the pockets of the guys running the groups. It's going in there because it's a very good asset class.
Chris, do you have a view on re-reg in Washington and Dodd-Frank, and what's all that going to do? It's obviously going to change the multiples that banks can lend money at. They're going to have to be a lot more capitalized. A lot of the most profitable parts of the bank's businesses pre-crisis have sort of been walled off against them. How quickly do you see them back actually offering money in the debt markets versus the non-bank debt market that's really funding what's going on right now?
Well, again, I think the banks want to lend. I've got a little bit of insight. We sold our business 6 years ago to PNC, so I can at least give you an insight to the PNC world. And man, they're aggressive to put capital out right now. When you look at the number of loans that have been repaid, they're actually struggling to keep their loan balance equal, or flat. Loan balances are tending to come down. So they're very aggressively trying to put capital out there. The one good thing about the increased legislation, I think none of us really focused on the capital requirements of banks. It was kind of crazy when you think about it, right? Banks' capital requirements were what, 3%? 3.5%, something like that. It was incredibly low. Lehman was levered 20 to 1. 20 to 1 they were levered. And I'm not sure anybody really knew what was in Lehman. It was a bunch of junk. There's a lot of stuff that's in there, real estate deals, and it was levered 20 to 1. Crazy. In hindsight, crazy. So now the capital requirements are up to 9-10%, I think, roughly 10%. I think that's a very healthy thing for our economy. I think it's a cleansing we had to go through. These banks had to write off a bunch of, bad debt. I feel like the banks are actually in fairly good shape right now. And you see it where their loan losses are being reversed now. And banks are coming up and having to take one-time gains because they're reversing their loan losses that they had booked in '09. So, long-winded way to say, I think it's been good, and I think that kind of legislation has frankly been a positive. Anybody else? Questions? Yeah.
Chris, can you talk to the dynamics of the deal? I guess it's kind of the intensive times and, the owner stakes in it versus management. Can you bring us inside of that a little bit on some of the excitement and some of the heartache that folks go through?
Well, it's interesting. When you read about transactions, it's like anything else in the press. I feel like you always get the negative side of things. To me, again, so much good is created in a lot of these transactions. I mean, look, I think Bill's a great example. Bill and his partner did a great job with their deal. Their management team did a great job in the transaction. And that's very typical for middle market deals, where there's been a lot of lives that have been enriched by these transactions. You look at private equity. Private equity kind of gets a bad beat, right? I mean, you read about the deals gone bad and all that stuff. But the basic private equity deal takes a company and gives a broader management team ownership. I mean, it gives the top 4 to 10 managers ownership in a company that they probably did not have before. And it gives them an incentive to run a better business, build their business, make it more efficient. And I think if you went back and looked at employment stats of companies that have been private equity owned, my bet is you would see a higher growth of an employee base post-deal versus companies that just were not owned by a private equity group is my bet. And it's all about incentive. They now have stock in a company, and they're very motivated to make that stock's value grow. Now, how you get there is the trick, right? Because there's always that friction of a management team becoming owners for the first time. How do you negotiate an option package or an equity package? You've got an equity group that wants to, put their arms around these guys because they're going to be partners, but at the same time they're working for their limited partners, so they don't want to give away more stock than they really need to. So there's always that friction that you got to guide a management team through. And it's tricky, but there are norms. I mean, most people try to stay within the norms. In a private equity deal, I would say most option packages tend to be somewhere between 10 and 15%. The strike price typically is at the going-in price. Usually it can vest over 3 to 5 years. So there are some industry norms, but there still is that friction getting from conceptual package to actual legal package that management teams benefit from. But I have seen so many managers and families who would have never had stock, ever, be enriched through private equity. And that story just doesn't get told out there. I mean, it just doesn't get told, but it absolutely is the fact.
Why do you think a company like Microsoft, maybe Cisco and Intel, large caches of cash, can't seem to get it right?
You mean dividend the cash, or yeah? I think companies like that just love to have a war chest, and they know if they dividend the money out, they just can't get it back. And so, I think they rationalize themselves into it and say, look, we've got to have 10 billion, 20 billion, 30 billion of cash sitting on the balance sheet in case that right opportunity comes along, because you just can't get it back. I'm not saying that's the right choice. It may not be a choice I would make or you would make, but that's the choice that they've made. Microsoft is in an interesting position. I mean, I think that is one that's very interesting to watch over the next 5 to 10 years, because it could look radically different if they make a pretty significant acquisition. So stay tuned on that one. Other questions? Yes.
Small community banks, true community banks, are still struggling quite a bit. Do you see that could potentially lead to problems in M&A 5 years from now when those companies start growing and need to make acquisitions to do that?
In terms of the
Being able to go out and get money to grow in this space?
I don't think so. I mean, I think the debt availability today versus a year ago, I can't begin to describe to you how it's changed. A great example. We sold a business, probably late '08, early '09, which was this really cool business that made these high-end military cases that optical equipment was shipped in. Really, really neat company. And we were selling it to the other, sorry, uh-oh. Oh gosh, now I don't know how to turn it off. The other player in the industry, and they were only levered about 1.5 times EBITDA, so they weren't levered by very much. And we could not get them to step up. They were scared to death that the banks would not step up and support that transaction, even though they only had a 1.5 times leverage on their balance sheet. We ultimately convinced them that, look, just go out and get junior capital, beneath the 1.5 to go do this deal. And thankfully they did, and it's been a massive home run for them. But since then, just times have changed. Leverage is absolutely available out there. So I know smaller community banks still are in trouble. I think that cleansing process is not all the way done. I don't know if it's 50% done or 60% done, but we still have some pain with these smaller community banks. But the big banks who are really professionally run and have wiped off a lot of their bad debt from their books, man, they are open for business in a very, very meaningful way. Big time. Other questions? Thank you. I really enjoyed today and appreciate it.
I think we might want to start making some buttons that say WDN, WIP deficits now. Chris, we want to thank you. I thank you for your education advice. We always appreciate your perspective on, what our students need to know. We appreciate your analysis, we appreciate your predictions, and we appreciate your hiring our students. So
Anytime.
thank you so much.
Thank you, Nancy. Appreciate it.
Thank you all, and we'll see you outside.